Hi friends, welcome to Adda 24/7. We are in the most important questions and case studies for CAIIB. I am covering BFM and ABM module A and C. So follow the series completely. Share it with your friends, share it on all your social media platforms, like the channel, subscribe to the channel, click on the bell icon. Do it first only, isn't it? So that later you may forget, I may forget to tell you, do it first only, isn't it? Let's start with the first question. See, today we'll be solving some questions, one or two case studies, numericals, and some theory also. Okay. The loan review should focus on which of the following matters: accuracy and timelines of credit ratings assigned by the loan officers, reference to internal policies and procedures and applicable laws, post-sanction follow-up, sufficiency of loan documentation. So, what is firstly tell me what is loan review? What is a loan review? See, a loan review means basically we are talking of credit audit over here. Kindly understand this. This is chapter number 27 or 28 in your books. Okay, credit audit. So here this topic's name is actually credit audit. Okay, and this audit is not of the customers. This audit is generally of the banks. Okay. So this credit audit should focus on what? Accuracy and timelines of the credit ratings assigned by the loan officers. Obviously, isn't it? Accuracy and timelines of the credit ratings. Ratings means what are the ratings given to which each customer. Every bank has a rating form, and this rating form is used to rate that customer and give accordingly decide the rate of interest. Okay. So we must always check up to what time is the rating given. Now ratings can be given by external agencies also. So we have to check that external agency rating timing also. Okay. A reference to internal policies, procedures and applicable laws, isn't it? What does your loan policy say or loan guidelines say? Isn't it? Every bank has a separate loan policy. Every bank has it. It is signed by the board of directors. So what does that policy say? Internal policies, procedures, applicable laws. Now laws means what? This laws over here, it means the laws of the land. Okay. Or what does the RBI say in our country? Okay. Then post-sanction follow-up. After sanctioning, whatever conditions are written in that sanction letter, are they followed or not? And last one is sufficiency. Are all the loan documentation proper or not? Legal, okay, legal, financial, and this KYC. Okay, so the answer is this ABCD, isn't it? See, benchmark relating to money market, government securities, foreign exchange in India is regulated by. So benchmark related to money market, government securities, foreign exchange. What is this benchmark? Benchmark means basically you can call it a repo rate or like repo rate. Who governs it? Reserve Bank of India, Financial Benchmark India Private Limited. Fixed income money market and derivative association of India means basically FIMDA and IBA, Indian Banks Association. So which one regulates this? Now many of you will answer it as A, RBI, because we know RBI. RBI regulates everything. But it's not that. Okay? RBI is not the answer. The answer is actually, let me see in the comment section from your side first. What is the answer? Answer is actually this FBIL, Financial Benchmark India Private Limited. Okay? This is a company owned by RBI. Kindly note, this company is owned by RBI. Okay? But this company gives you the two things. One, see this, RBI gives you the repo rate, and this company gives you a benchmark, separate benchmark. Now RBI has told the banks either you follow the repo rate or this benchmark, or okay, you follow either the repo rate or the benchmark. Anyone you can follow. So that's why the correct answer over here is FBIL, Financial Benchmark India Private Limited. Okay. Which of the following is not the key principle of supervisory review mentioned in the pillar 2 of Basel II norms? So not a key principle. Kindly note. Now remember, there are four key principles of SREP. Four of them. Now we have to search which of them is not there in this SREP. Pillar 2 we are talking of. Okay. Banks should have a process of assessing their overall capital adequacy in relation to their risk profile and strategy for maintaining their capital levels. Banks should maintain risk-weighted asset capital requirement at any time. Bank supervisors need to review and evaluate the bank's internal capital adequacy assessments and ensure their compliance with the regulatory capital ratios. Supervisors should intervene at an early stage to prevent the capital from falling below the minimum levels. Now see here, out of these three are correct, one is not correct. Which one is not correct out of these? What do you say? Which one is not correct over here? The false answer is this. This is a part of pillar 1. Pillar 1. Okay. So this is not the part of pillar 2. Remaining everything, banks should have a process of assessing their overall capital adequacy. So basically they should have their own methods of assessing their overall capital adequacy, means CRAR ratio. Bank supervisors need to review and evaluate bank's internal capital adequacy. That's the job of the supervisor, means basically RBI or auditor. Supervisors should intervene at an early stage. Early stage means at the level of SMA 0. SMA 0, 1 or 2. This is the early stage before becoming NPA. Right? That's why we have that joint lenders forum. That is in SMA 1 and 2 only. Okay? So this is not the part of pillar 2. This is a part of pillar 1. Okay? There's one more. See here, in pillar 2 has one more. But that is related to the supervisor. The one more which is not mentioned over here, it is related to the supervisor. Okay? Banks are required to maintain pillar 3 disclosures as per the RBI guidelines, at least on a dash basis, irrespective of whether the financial statements are audited or not audited. So banks are required to maintain the pillar 3 disclosures. Very important question. You mind it, you will get this in the exam. Banks are required to maintain the pillar 3 disclosures as per the RBI guidelines, at least on a dash basis. Quarterly, half yearly, at the end of September each year and at the end of March each year. What is the answer? Whether the financial statements are audited or non-audited. Financial means balance sheet, P&L and cash flow. Whether they are audited or not audited. Then also you are required to maintain, as a bank, you are required to maintain this pillar 3. What is pillar 3 disclosure? Pillar 3 is related to your market discipline, corporate governance. See here, pillar 1 is your capital adequacy, pillar 2 is SREP, supervisory review, and pillar 3 is this market discipline. That is related to the investors, so that the investor knows everything what is happening in the bank. That is pillar 3, corporate governance. So what is this disclosure required? When is this required? What is the frequency? The frequency over here is half yearly. Kindly note. Very important question from your exam point of view. Mind it, you will see this in the exam. From the following, calculate the risk-weighted asset of the bank. So we have to calculate the RWA. Paid up capital is given as 1000 CR. Tier 2 capital is given as 2000 CR. Debentures are given as 100 CR. Risk weight is given as 90% for these debentures. Mortgage is 250 CR. Risk weight is 75%. Loan to government is 150 CR. So there is no risk in this loan to government. Now you have to calculate the RWA, risk weighted asset. Firstly, what is risk weighted asset? Risk weighted asset means that asset which is not backed by any security or any hedging instrument. Okay. Let me solve this. This is a case study. See this. First, let's solve this. What is given first? First part is what? What is this? Debenture. Debenture is given. First, focus on the risk. Debenture is given as 100 CR. Risk weight 90%. So 100 into 90%, 90 CR. Mortgage is given as 250 CR. Risk weight 75%. So multiply this. 250 into 75%, 187.5. And loan to government. So there is no risk involved in this. Complete. This is free. 0% risk. So 0. So what is the RW over here? Means what is the risk weighted asset? The risk weighted means where there is a risk involved. The risk weighted asset is this 90 CR, 187 CR, means total is 277 CR. So 277.5. So this much is your this risk weighted asset. Now suppose if I ask you to calculate, see, answer is done. Your answer is 277.5 CR. Question is over. Now further part I'll tell you. If I ask you to find out, let's say CRAR, then CRAR is what? Capital. Whatever is the capital given. Paid up capital is given as 1000. Tier 2 is given as 2000. But you don't take 2000. Kindly note, T2 can never be greater than T1. So 1000 plus 1000. So your total capital will be 1 plus 1, 2000 CR. Your capital will be 2000 CR over here. And RW is 277. So this is how you will be calculating. I won't go into deep into that because that is another problem altogether. It will take a lot of time. But logically I am telling you, capital is always tier 1 plus tier 2. Tier 2 can never be greater than tier 1. So 1 plus 1, 2000. Even though it is given as 2000, you have to take 1000 only. So 2000 is your capital and your risk weighted asset is this total, 277.5. Divide it and you will get it CRAR. A huge strike is taking place in a factory in Rajasthan. The materials which need to be exported are not ready by the deadline. In this case, which type of international trade risk is experienced by the buyer in Seattle, USA? Political, shipping, exchange and operational risk. Which type of risk? Getting the points here. There is a supplier in Bharat. Okay. This supplier is supplying some goods. Now there is a strike in the company of the supplier. So the buyer in USA who has ordered the goods will not get the goods, right? So which type of risk is this called as? Political, shipping, exchange or operational risk? What is this called as? Think over it, everyone. Let me check who's giving the answer first. Who gives the first answer? Let's check this. Comment section. Everyone in the comment section. It is called as fast. Operational risk. Okay, because political is different, shipping is different, exchange is different. This is this operational risk. See here, it relates to, see this. This is strike issue. Strike issue means operational. It relates to the operational issues at both ends, or even at the supporting organization's place. Means it can be anywhere. Strike can go anywhere, dacoity can go anywhere, floods can go anywhere, or any natural calamity can go anywhere. These are all the operational hazards. Okay. So strike at the seller's factory or even at the seller's raw material supplier's factory, whoever it might be. Transporter, trucker, loader, shipping company, anywhere the strike can go on. So these are all the operational risk issues. Similarly, operational risk breaks out from the failures of the systems also. Means there is no strike, but the computer system fails. So that can also be the operational risk. Okay, got it? Next. Export Credit Guarantee Corporation Limited, ECGC, was set up in India in which year? So ECGC was set up in which year? ECGC. It was set up in 1964. Okay, ECGC was set up in India in 1964. Okay, means in 1957 the government of India established Export Risk Insurance Corporation, ERIC. Firstly, in 1957, ERIC, to provide a credit risk insurance to the exporters, which was then transformed to Export Credit Guarantee Corporation in 1964. Okay, so that was the point. Next one. Which type of ECGC's policies cover risks in respect of export of capital goods and turnkey projects involving medium and long-term credit? So ECGC has many policies. Remember, I'll just give you the broad view. ECGC has two types of policies. Okay, mainly three, but we call it two only because there is a special case-to-case basis. That's a separate policy. One is for the banks, and second is for the exporters. These are the two main policies designed by ECGC. Okay, so here we are talking about ECGC's policy cover risk in respect of the export of capital goods and turnkey projects involving medium and long term. So here we are talking of exporters policy, not of the bank. So buyer wise policy, specific policy for supply contract, specific shipment policy, and services policy. So which policy is used by ECGC for covering this capital goods and turnkey long term projects? Yeah, long-term projects. Remember, long-term project. Long-term project is always a turnkey or supply contract project. So this will be the policy used. Specific policy for supply contract. Okay, this is the policy used. A bit details about this policy. Let's see. Let me show you. This supply contract policy is suitable for the contracts which are for the long-term nature. Now we'll say what is long-term nature? Sir, it can be many things. I'll give you an example. Tomorrow if ONGC India's company, it digs all that oil wells, okay, throughout the world. So if ONGC tomorrow gets a contract from, let's say, some country in Oman or some country in Iraq, and ONGC has to dig the well. Now this digging the well can't be done in 1 year. You have to search, you have to do this archaeological survey, everything you have to do it. And after that you have to dig it. So it takes a lot of years. Roughly setting up that oil field will take around 6 to 7 years. So that's why these are suitable for long-term contracts. Now also these contracts are not repetitive. Means what? Will I go and dig this well? Okay, one well if I try to dig and it failed, then okay, next well immediately. It's not that. It's huge cost, huge. Okay, those who have done farming, they'll understand it. What is the difference between getting the water in the well and not getting the water? It costs you huge. Same thing is applicable there also. Not repetitive nature and which involve medium and long term contracts. So this is basically for this supply contract. Got it? What type of guarantee of ECGC covers post-shipment advances granted by the banks to the exporters against export incentives receivables in form of cash assistance, duty drawback? So cash assistance and duty drawback. Duty drawback means the duty which is paid by me, I'll get it back from the government. So post-shipment credit guarantee, export finance guarantee, export performance guarantee, and export production guarantee. Which is the policy used for this duty drawback and this cash incentive? Yes, it is. It is export finance. Okay, export finance. Okay. Yeah. So it's actually export finance credit. Okay, export finance guarantee. So what if it's basically export finance only, you can call it, or because the word guarantee is added, that's why we are adding the word guarantee. Okay, so this covers this duty drawback also. Now duty drawback means what? Duty drawback means what? Whenever I export something, I have to pay the customs duty, but the government of India is giving me incentives for this customs duty. Incentives. So these incentives I get it after some time, let's say 1 month or 1.5 months. Generally 1 month is enough nowadays. So up to that time my money is locked under those duties which I have to get back. So that is basically financed by the bank. Okay, it is suitable for contracts of grant post shipment advances. It basically to the exporters and against the export incentives. Okay. In case of cash assistance, duty drawbacks, everything which it gets from the government. Okay. Do you know ECGC is the fifth largest credit insurance company in the world? Fifth largest credit insurance company in the world. Okay. So that is one of the greatest things in the world. I'm not talking of India. Due to this insurance cover, the financial institutions are better placed. Means because of this insurance, they are better placed in the world market because they'll get the duty drawback, and in the meantime, by the time the money is locked, ECGC pays them, right? So that's why the supplier has better advantage of liquidity. Okay. Sunita was to choose a life insurance policy that pays certain percentage of plan sum assured after regular intervals. Which type of plan should she choose? See, your life policy. Now you'll say, what is this life policy, sir? Is this a BFM question? This question is of some retail banking, isn't it? How come this has come over here? See, remember one thing. BFM, it covers everything. They can ask you any question. They can ask you this ULIP question also, unit linked insurance policy. They can ask you anything. Anything under the sun can be asked, which is related to finance and the risk. Anything can be asked. So what does she want? She wants that certain percentage of the plan sum assured after regular intervals. Means what? Regular intervals means what? See this. I take this policy over here. This policy is for, let's say, 20 years. Okay. 20 years. So what does she want? Every 5 years, 1, 2, 3, and last this 5. She wants some amount. Okay, some bonus, something. So this type of amount we get it in which policy? Whole life, endowment, money back, and ULIP, unit linked insurance plan. Where do we get this? Okay, this is from your actually JAIIB. So many of you should be able to answer this. Whole life, what is whole life policy? Whole life, okay, I'll give you some clarity. Whole life policy is only one premium paid throughout the life of that policy. Only one single premium policy we call it. Endowment means wherever I get the money back, money I receive it back, means whatever I pay, premium I pay, I get that premium back along with the bonuses. Money back is a special type of endowment, special type. This is the right answer, where I get certain percentage of the sum assured, okay, at regular intervals. Every 5 years, 3 years, 2 years, whatever is guaranteed by that plan. And ULIP means what? Unit linked insurance plan. This is a plan which invests in shares, basically stock market. Of course, there are various options available in this. Not only shares, they are available for debt also and liquid also. All of them are available. Okay, liquid. But mainly say this: anyone who invests in ULIP, that person will mainly invest in shares only. Because if he has to invest in debt or liquid, why should this person go for ULIP? That person will go for the regular general endowment, right? So the answer for this is money back. In money back plan, you always get some part of that sum assured, some part of that premium which is paid at a regular intervals in your pocket. Okay. So that was an important question in this. Got it, everyone? Understood the concept of this ULIP and everything? Okay. Chalo. Next one. Now, okay. Now, here as a banker, we need to clearly understand the difference between these policies. Mainly endowment and term. You must at least understand the difference between them. Remaining is okay, but endowment and term are the main policies which we face on a daily basis. So as that, see here, now we are on the end. So I'll suggest you to join the Adda 24/7 classes immediately. Okay, I'll show you how to join it. Always join it through the app. In the app, you get 1% extra. Click on JAIIB and CAIIB. Go to Adda 24/7. Click on JAIIB and CAIIB. Click on CAIIB November. Just started. Okay. Use this crash course batch for your scores. All the important points, details, case studies, everything is covered. So join it immediately because the exam is very near. And what are the discount offers? Look at this discount offers. Click on JAIIB and CAIIB, this crash course batch. Look at this. Click on this crash course. Ebooks, test series, online live classes, everything. Very important ebooks and test series. Okay. And what is the discount? Look at this. Click on buy now. Never forget the code Y432. Y432. Never forget it. Click on apply. Look at this. 80% off it's going on. Plus 1% using the app. So 81%. Join it ASAP. Don't miss this. Even I would suggest you to join the Mahapack. In Mahapack you are getting multiple batches. 15 plus batches per subject. Plus double validity. Double validity means you buy for 6 months, you get it for 12 months. Buy for 12, you get it for 24. So it is double.